are in listen-only mode.
Good afternoon. Welcome to part 2 of Accounting for Construction Companies. This is Victoria Beale with the Ohio LTAP Center, and we are so pleased to be partnering with the Supportive Services section, which I'm sure all of you are familiar with Micah Flanagan, who has responsibility for that program from the Ohio Department of Transportation's Division of Opportunity, Diversity, and Inclusion. This is the 6th component of a training series that has been offered, and this is part 2 of the accounting training. And we have for you our presenter, Luis Cartagena, who is with us again today and will be covering the rest of the information on this topic. One thing I want to mention is we do have handouts for you in the handout section of the GoToWebinar box. So if you could please access those handouts from there. If you didn't yesterday, that would be great. Also, we are going to be taking questions through our question box today. And one of the things I wanted to do was to ask you to please find that question box and just put hi or hello in there and send it to me so I know that you've been able to find it. So we appreciate that as well. Want to make sure that everyone knows where that question box is. So that way you can use it during the webinar to ask questions of our expert presenter, Luis. So with that, that's all I had, Luis, if you want to go ahead and take things away.
All right, thank you, Victoria.
Thank you.
Good afternoon. I want to thank those of you who are joining us once again for the second part of Accounting for Construction Companies. For those who are joining the webinar for the first time, my name is Luis Cartagena, and I'm a certified public accountant with over 20 years experience. I'm president and CEO of Cartagena CPA and Consultants, providing services in accounting, financial management, consulting, and tax. I also once again want to thank the Ohio Department of Transportation for the opportunity to present these webinars. To recap what we learned during part 1, we discussed different methods of accounting, such as the cash method, where you recognize income and expenses when money changes hands, and also the accrual method, where you recognize income and expenses as incurred. We discussed the completed contract method, where you recognize revenue and expenses when the project is complete, and the percentage of completion method, where revenue and expenses are recognized at regular intervals over the term of a multi-year project. Lastly, we discussed the balance sheet, income statement, statement of cash flows, project budgets, and planning for expenditures. I remind everyone that yesterday's webinar, including the webinars on estimating and contract law, are available for viewing through the ODOT Ohio LTAP e-learning catalog. Please feel free to ask any questions you may have during today's presentation. And if I can't, for some reason, answer your question during the presentation, I will ensure to follow up via email. Additionally, all of the handouts are listed back up, including the ones that were utilized yesterday. At this time, I'm going to ask Victoria to please put up our first poll question.
It's up. It says, do you have an active business plan or growth plan? Yes or no? We don't record your answers, so you can feel free to vote however you choose. Okay, we've got 80% responding already. That's great. I'm going to close the question down and share our responses. And we have down that 39% of you said no, but 61% of you said yes. There you go. Thanks.
Thank you, Victoria. And that is good to know. 61% of you said yes to having a business plan or growth plan, and that is awesome news. And for the 39% of you that do not currently have one, I am hopeful that by the end of this presentation, you'll have enough information to get you started and working on that. I really like this poll question because in my opinion, having an active business plan or growth plan actually allows you to determine when to make the big investment or when to hold back on spending as a business owner. The key item in all of these decisions is timing. In order to decide the right time to push forward or hold back, an understanding of your cash flow or working capital is essential. There's a statement that I usually like to make at the end of some of my presentations, but I believe it's better to read it at this time. The anticipation, understanding, and planning of working capital needs, along with analysis of cash inflows and outflows, assists with managing the timing of decisions to take on new opportunities and the associated costs. I do not believe that you can make these decisions wisely without having an idea of how you want your business to grow. It is important to be fluid with your business, but manage it without being reactive. Everything that is occurring with your company should be on purpose, by design, and a completion of a journey that you already planned. So as we look at the slide, we see that cash flow is defined as the net amount of cash and cash equivalents being transferred in and out of the business. Working capital is defined as current assets minus current liabilities. And as we went through the discussion of components of a balance sheet yesterday, we'll share again that current assets consist of items such as your cash, which is your bank account, short-term investments, which are investments that end within a year, accounts receivable, inventory items, and prepaid expenses. Current liabilities account for accounts payable, current portion of long-term debt, payroll liabilities, and taxes payable. So as you can see, the current assets are all of the items that are liquid, that wouldn't take you a long time to turn into cash if it currently isn't cash. In the handouts, which I'm hopeful each of you was able to download, is included a cash inflow template, which is what I have showing here on the slide. I've only included a time frame of 5 months on my example, but you can alter this template to include a broader range of time with Excel or utilizing a table in Word. You can use this template to review the potential inflow and outflow of cash for one project or even for your company as a whole. Obviously, the items as income item and cost item are interchangeable. The thing to remember in adding information to the cash flow template is that you are looking at the timing of when the cash will come into the business and the timing of when the cash will go out of the business. Keep this in mind when creating a template based on a single project. Additionally, remember, a lot of times, projected outcomes are just that, projected. Use your best knowledge of your circumstance and business when deciding the timing of both cash inflow and outflow. As you can see here, I included 3 income items and 3 cost items to keep the example simple. In the handout, you should see a key which we will utilize to complete the template. The key is listed on page 2 of the handout, Cash Inflows Template. As we look at the key, we see that income item number 1 is providing us a cash inflow of $10,000 a month. So as you can see, May, June, July, August, and September each shows $10,000 in cash inflow. Additionally, income item number 2 shows $10,000 in June and $10,000 in August, with income item number 3 showing $20,000 in July and $20,000 in September. As we review the cash outflow, we see that there are $5,000 a month in expenses, cost items that are going out between the month of May and June, July, August, and September. Additionally, cost item number 2 shows $5,000 in May and $5,000 again in July. And cost item number 3 shows $10,000 in June, August, July, and September. As you can see, based on what we know about the timing of the cash inflow from revenue and cash outflow from expenses, we are breaking even in May and have cash available during the next 4 months. Our best month being September, where we will have $15,000 of cash left over. So as you analyze the results, let's imagine this is your company. You have 3 steady contracts over the next 5 months and know the timing of when cash will come in and go out. This is the information you will need to utilize to decide when to spend the available cash. For example, you started your business and have a home office, but you want to expand into a leased office space to bring in staff. You have found a space that will cost you $1,000 a month for 2 years. You probably wouldn't make that move until June, which is the first month where you would actually have an available cash flow. Now, let's say you wanted to purchase a piece of equipment that will cost your company $50,000. You can purchase it on credit, but you need a deposit of $5,000. It would make better sense to not make that purchase until sometime between August and September, when available cash flow is higher, since making that decision in June would completely deplete your cash flow reserves. Now imagine if any of the cash inflows projected here suddenly do not come through. Let's say we lose revenue item number 2 and do not receive the $10,000 cash inflow in June and August. We now have 2 months where our cash outflow will be higher than our cash inflow by $5,000. This would mean we now have to figure out how we are going to cover the $5,000 projected cash outflow in June, knowing we will not recoup the dollars until July. August would also net us negative cash flow of $5,000, which means through 4 months of operation, our total cash flow would be 0, and we wouldn't have any additional available cash until September. This would completely change the timing of your decision to expand into new office space or purchase that piece of equipment, because such a dramatic loss of income between June and August would basically render you a break even. I'm not going to go into more examples, but it's important to understand how to anticipate your cash flow, because it will tie directly into understanding your working capital needs. At this time, I'm going to ask Victoria to please put up our second poll question.
It's up. What is your company's biggest capital need? Employees, equipment, other. Wow, they're voting very fast. They know it.
That is good.
Yep, here we go. Close the poll down, share the results. These 52% of them said employees, 19% said equipment, and 29% said other. So I'll hide that poll. It's all yours again.
Thank you. Thank you, Victoria. So working capital needs, anticipating, understanding, and planning. With someone having an idea of what their company's biggest capital need is, 52% employees, 19% equipment, 29% other. It's important to really be able to anticipate and plan when you're going to take on these additional costs, if it's based on growing, or when you may have to cut back. There's always an opportunity to cut back. Working capital is current assets less current liabilities. The bottom line is that working capital is how much cash do you have available to spend. Again, items such as employees and equipment, and maybe even an investment opportunity. The goal of cash flow forecasting is to determine deficiencies or excesses in cash flow that may occur in your business during the periods for which the projection is prepared. That's important to understand that we are talking about timing, and so the projection may be over a certain period of time, as in the example, it was only 5 months. You can decide how short of a window or how long of a window you want to give yourself when you are planning and working on your projections. There's no right or wrong. You can be at 30 days. You may have so much going on, you may need to look at this weekly. And obviously, everyone should be looking at this at least on an annual basis. Cash outflow will likely occur before cash inflow, which directly ties back to anticipating working capital needs. Understanding how much cash you have available to cover current liabilities can help you determine if going after a new opportunity is worth it and whether you will need resources to cover the additional costs of the new contract. I believe a lot of us go through this decision-making process when having to anticipate payroll for a new contract. We have to understand the timing of when the project owner will pay our invoice and how much cash we have available to cover our payroll until we get that invoice paid. We recall from yesterday that current assets are items expected to be converted into cash within a year, such as cash, cash equivalents, accounts receivable, inventory, marketable securities, and other liquid assets. We also recall that current liabilities include accounts payable, wages payable, and short-term debt, along with the current year portion of long-term debt. From a financial management perspective, working capital is simply current assets less current liabilities. It provides insight into the financial health of a company. And the reason why I use financial management perspective is because there's ratios and all kinds of other formulas that are utilized by investors as well as loan underwriters to see how good the financial health of your company may be. So just keep that in mind, that this is always wearing the hat of financial management and cash management. So now we have spent some time discussing cash flow analysis and anticipating working capital needs. That pretty much gets us to the point on what we need to do now when we realize that we have shortfalls in our cash flow or working capital. As I mentioned at the beginning of the presentation, the anticipation, understanding, and planning of working capital needs, along with the analysis of cash inflows and outflows, assist with managing the timing of decisions to take on new opportunities and the associated costs. Which now brings us to understanding our net worth. Net worth is defined as follows: the value of assets minus liabilities, which interprets into what you own versus what you owe. If you have more assets than liabilities, you have positive net worth. If your liabilities exceed your assets, you have negative net worth. Net worth allows you to evaluate your current financial health, and this is important because it helps guide you to know the right time to ask for capital. As I illustrate on the slide, when should you be looking to obtain capital to grow your business? We know that cost brings revenue down. We know that it costs money to actually make money, and that this becomes a continuous cycle. So when you understand your net worth, it may bring you to realizations that I have come to over the years. Some conclusions that I myself have come to is that you should actually be asking for capital when you do not actually need it. I'll repeat that because it sounds so weird sometimes, but it's the truth. You should actually be asking for capital when you do not actually need it. If you're planning diligently, you should see a point in your business model where your company will show it has the ability to handle the additional cost to pay back an infusion of cash from a lender or a potential investor. You may decide to obtain a line of credit. You may decide to obtain a loan. You may decide to partner up with an investor or another company, merge, which would mean it's an equity transaction. And because of that, you need to understand each factor and the cost that will be associated to each. So when you try and understand the cost of borrowing, you should look at the annual interest and how does that factor into your cash flow, because obviously your loan repayment will need to be covered. In your loan application, you'll probably submit current financials, current balance sheet, and current profit and loss statement. But a lot of times they're requesting projected profit and loss statements. Part of that, and part of the reason why they're asking for those projections, is not only do they want to see and get a clear picture of what you expect to come into the business as far as cash inflow, revenues, and things like that, sales. What they really want to see is how are you accounting for actually paying back this loan or paying back a line of credit. Obviously, with a line of credit, you are only paying interest on the amount that's still owed at the end of each month. So having projections will show the lender that you've planned and accounted for how you plan to pay this loan back. But you have to understand how it's going to affect your cash flow and expenditure budget, because that could very well bring you to the decision that equity may be the actual better option to expand. You also have to understand whether your capital need is short-term or is it long-term. If it's a short-term need, then getting a loan or a line of credit would actually be the better option, especially if it's a short-term need, because you'd only pay the interest on the months that that particular debt is still open through a line of credit, and immediately upon having the ability to pay the complete line back down, you would, and now you wouldn't have another cost. But if it's a long-term need, something that through your projections and budgets, you understand that you're not going to be able to pay back the full sum in less than 12 months, then a loan for multiple years with a better interest rate may be your better option. But if you're at a point where your cash flow is negative and you're trying to obtain this loan, and your better months or better time period where you were healthy and showing a lot of income coming in isn't reflected in the current financials, where you're now showing months of losses or falling behind or having a lot of debt, then your loan will be a lot more difficult to obtain because you waited until you actually needed the money. And that's a difficult thing to understand, because why would you want to take on debt while you don't actually need it? But for the 61% of you who have a growth plan or a business plan, these are options that you may undertake to decide that I'm going to get into this potential loan so that I can now expand my business, whether it's through another location, whether it's through adding equipment, whether it's through adding employees, because now that expands your capacity, more employees, more work, more locations, more ability to go after other contracts. And so these decisions are better made as you're reviewing your growth plan, reviewing your current financial statements, and understanding your cash inflow, outflow, net worth, working capital to ensure that you are making the request at the right time and that the bank is going to see you as bankable. And this is also you anticipating hard times. Everything isn't always going to look great. We're not always going to have a bunch of contracts coming in. And this is the ability for you to get ahead of that while your company looks like it's in good shape. At this time, I'm going to ask Victoria to please put up our third poll question.
I've launched it, and it says, do you maintain communication with your bank's relationship manager? Yes or no? And they're voting. I know when I read this question, I thought, boy, that's a very good thing to think about. Okay, Luis, we're there. I'm going to share the results. 65% said yes and 35% said no. I'll take the results down now. There you go.
Thank you. Thank you very much. I asked that question because this time that we are in right now with the coronavirus, COVID-19, a lot of places being shut down, the SBA and the government, state governments, local governments, everyone's scrambling to come up with a loan program to assist small businesses during this time. Companies affected by the shutdown, having to lay off employees because there's no income that's going to come in. You guys would not believe the amount of phone calls that I have fielded over the last several weeks from companies that are scrambling to just put together the necessary reports that they have to put together for these loan requests. Not everyone is operating from a payroll. So obtaining payroll reports when your accounting is being handled by just a review of your bank statement every month definitely threw people for a curve. And the reality and the sad reality is that this is something that obviously unexpected, but without reviewing your financial statements and without having growth plans, business plans, budgets that you're looking at, this may be something that will kill a lot of small businesses who may never recover from the stoppage in income. And so when I asked that question about communication with your bank's relationship manager, I'll share a story with you guys, a little bit more personal. There was a time where I had several businesses early on in my youth, and I did not have a relationship with the manager at my operating bank. I did not have a relationship with any local government official or economic development official in the city where I was located. I also did not have a relationship with any local small business development association or center. And I ran into financial trouble. My sales were slowing down. The expenses were growing. I had employees and I just couldn't keep up because the sales weren't coming in. And I tried to get assistance. And I ran to every single one of these entities that I mentioned now, my banker, the local chamber, business chamber, as well as the local economic development office of the city where my business was located. And I spent a lot more time just explaining what my business actually did and who I was than actually talking about the issues that I had, the financial trouble that and lack of capital that my business was suffering from. So I learned the hard lesson that day that I like to pass on to people, and I share this story because it's important to maintain that communication with your bank's relationship manager. The first day of the payroll protection program coming out, I spent about 4 hours in the morning talking to 3 different banks on behalf of several of my clients, and no one at any one of these banks could give me a clear answer on what documentation sole proprietorships, independent contractors, one member LLCs were going to have to turn in order to apply for this payroll protection program. Additionally, I heard a lot of stories from people who had not even heard back from their bank. And it reminded me that unfortunately, we don't plan for hard times. We're not expecting emergencies. But most of the people that probably got this money, which, we're still waiting on more money for it to be funded, it all started with whether or not your bank relationship manager actually knew you. If they didn't know you, if they didn't have any idea of what your business did, if they had no idea of what your company and how many sales your company was bringing in, maybe they even never caught a glimpse of you doing any banking at the actual office, you probably didn't get a call back. And that right there already started the issues with your cash flow or obtaining a loan to get you through these tougher times. So I know this was a long-winded way for 65% of you to know that you're doing something well. But for the other 35%, if you haven't and you don't, please ensure that you start. Your financial management of your business is important to include that bank relationship manager relationship. Specifically because they will be a resource to you. They will know when the right time for you to be asking for a line of credit or a loan request should be. It's not a bad thing for a quarterly or 6-month meeting with your relationship managers just so they understand and see what's happening with your business. They could easily be queuing you up for a line of credit, and they would actually be working with you to let you know when the right time to apply is. And so what I'm going to discuss now as I look at the slide is just to continue to drill the idea that it's all about timing. And I've included a ratio handout which looks at few ratio underwriters will use when evaluating your loan or line of credit. So as we look at these ratios on the slide, we see liquidity ratios measure the ability of a company to pay maturing obligations. Activity ratios measure how effectively a company is using its assets. Profitability ratios measure the success or failure of a company for a given period of time. And coverage ratios measure the security for long-term creditors and investors. And as we look at the examples of ratios, I'll start with an example of a liquidity ratio. It's called the current ratio, or sometimes called the working capital ratio, which is current assets divided by current liabilities. What does it help us determine? Is the ability of a company in paying its short-term debt. So the higher the ratio, the better position the company will be in. Next, we look at an activity ratio, which is accounts receivable turnover. This is a good ratio for everyone to take a moment every once in a while and see how well they're doing. It's basically going to tell you the success of a company in collecting its outstanding receivables. So you're going to take your net credit sales and you're going to divide them against your average net receivables. That's going to determine whether you are collecting your accounts receivable fast or turning them around slow. A higher ratio indicates the company may have quality customers who pay their invoices fast and on time. And again, drilling, it's all about timing. So there may be periods of time where you're dealing with great customers, and this might be the right opportunity and the right ratio to utilize to obtain and look at whether it's the right time to obtain a loan. Profitability ratio, net profit margin. You take your net income and divide it against your net sales. What does that determine? How much profit is generated as a percentage of revenue, and it can assist the company in deciding whether an opportunity is worth pursuing. And we end with coverage ratio, the debt ratio, also called debt to asset ratio, where you're looking at your total liabilities, current and long-term, and you're dividing them against your total assets, current and long-term, current and fixed, my apologies. So what does that help us determine? How much of a company's assets are being financed by debt? In this case, you actually hope you get a lower ratio or percentage because it helps you determine the risk level of a company. Obviously, the higher the debt ratio means the less assets there are to cover liabilities or debt. With any loan request, you're going to be asked for a use of funds statement. A use of funds statement usually starts with the source of the funds, whether it's an equity infusion, a line of credit, a loan, and of course, what is the total of the source of the funds. And then you're discussing how you're going to use those funds. So equipment, payroll, working capital, and then the total use of those funds. An important note to mention here is that source of funds will also include a line for your own investment. Sometimes when asking for capital, an entity such as a loan request from an economic development department within a local city or county will want to see the owner pull up collateral or 10% of the asking amount. They ask that so it shows that the owner has a bit of skin in the game. You would showcase that amount with the use of funds statement under the source of funds. We now want to move on to tax implications. This slide, we're going to discuss independent contractors versus employees. 1099s for subcontractors, as well as additional employer tax for Social Security and Medicare. Some of you may understand this, and some of you may not, and I hope that you still, whether you understand it or not, can find time to ask questions. So when you hire an employee, you get the advantage of being able to completely control and direct that person's work during the work time, to train the person in a way you want the job done, and to require that person to work only for you. When you hire an independent contractor, you can assign duties to an independent contractor and impose a deadline and work product, but you cannot tell that person how to get the job done. An independent contractor can work for others, can often set his or her own work hours, and often provides his, her, or her own tools. This is the key distinction. If you are going to control the person's work, and they cannot work for someone else or set their own hours, they are an employee. Additional employer tax for employees includes the matching amount for Social Security and Medicare, and of course, federal unemployment tax. If you hire an independent contractor, you will report the income you pay them annually through filing of a 1099 miscellaneous, which is provided to subcontractors that you pay $600 or more to throughout the year. A lot of times people get confused about whether they should use independent contractors or employees. So just keep in mind that if it's short term, you're only utilizing them for a while, then an independent contractor relationship may be the best. But if they're going to be hired on long term, you're going to control their duties, you're going to impose deadlines, you're going to tell them how the job needs to be done, and they're not allowed to work at the times they decide, then most likely that is an employee-employer relationship. So I want to spend some time also talking about structure. The most common is a C corporation, S corporation, limited liability company, or sole proprietorship. I'm going to take a little bit of time to talk about tax forms, how to treat owner pay, and double taxation. So owner pay is definitely treated differently if you are structured as a sole proprietor. A limited liability company or a partnership, whether the limited liability company is a single member or two people, any payment to an owner is considered a draw and becomes a balance sheet transaction as it lowers the cash available in the bank account and lowers equity or the partner capital accounts as money was pulled from the company for the owner. If you are structured as an S corp, owner pay may be through normal payroll functions. Thus, the owner will receive a W-2 at the end of the year. If you are structured as a C corporation and do not pay yourself through payroll, any withdrawal of income to the owner is considered a dividend. This is important because dividends are taxable to the shareholder, but they are not deductible for tax purposes of the C corporation. To dive into this subject a little more, what occurs for most limited liability companies, partnerships, or sole proprietorships is that the owner draws are not a deductible expense for tax purposes. Your net income becomes the income earned when reported in your personal tax return. The income is taxed at personal tax rates. This means the business does not actually pay income tax, but the individual owner does through the claim of the net income on their personal tax return. This also means your company is not actually deducting any tax paid on behalf of the owner. It is booked as another owner's draw. Additionally, your net income is taxed a self-employment tax as a payment for Social Security and Medicare, since you're not paying into them throughout the year. If you are an S corporation, you as an owner must now pay yourself a salary commensurate with your industry. As a payroll employee, you will now receive a W-2 to claim your salary, thus making it an allowable business expense for the S corporation. You as the owner will receive a K-1 for your share of net income. That K-1 income is claimed as income on your personal tax return. The key difference here is that your K-1 income from an S corporation is not taxed the additional self-employment tax. The concept is based on the fact that as an owner, you were paid through payroll, and the Social Security and Medicare tax were paid through normal payroll deductions. Again, making it clear that an S corporation is also not paying income tax. which brings us to the C corporation structure. C corporations pay income tax as they file their own tax return on Form 1120. As an owner of a C corporation, you will claim income via your W-2 if employed by the C corporation, and a 1099 DIV for any dividend payouts or draws received throughout the tax year. Since dividends are not deductible to a C corporation, the income technically is included in net income of the C corporation, thus being taxed at the corporate return. The dividend income is claimed by the owner and taxed via the personal tax filing of the owner. This is how double taxation occurs. Owners who do not claim net income of a C corporation as the C corporation files its own return and pays tax at the corporate tax rates. Because of that, that's the clear distinction of the double taxation, is that a C corporation is filing its own return and paying its own tax against net income. And most shareholders who work for the corporation will receive a W-2 and claim and file through their personal tax return and pay taxes on that salaried income, and any dividends will be claimed by the shareholders and taxes will be paid through their personal tax return, thus creating the double taxation. Lastly, as we discussed accrual and cash method of accounting yesterday, there will be income that you claim in a tax year that you, as the owner of the business, may not necessarily have received payment for. So again, reminding you, under the accrual method, you're claiming that revenue and recognizing that revenue as the work was done. Where under the cash method, you are claiming and recognizing that revenue when you actually receive the money or pay the money out for the costs. So under accrual, there will be revenue recognized that you did not actually get paid for yet. Or there may be a check you receive for work that hasn't happened yet, which allows you to defer it and claim it in the following tax year. At this time, I'm going to ask Victoria to pull up our fourth and final poll question.
We have it up. How do you currently handle your company's accounting? Outsourced to an accountant/CPA, in-house accountant/bookkeeper, my spouse helps me, my bank statement. Okay, when they're voting. While you're doing that, I want to remind everyone that after the webinar completes, we will have a survey that'll be coming up, hopefully, that we would ask for you to fill out. And then we'll be following up on the webinar with a link to the handouts and also the recordings of the webinars. All right, we're good there. I'm going to close the survey down, share the results. So 50% said outsourced to an accountant/CPA, 40% said in-house accountant/bookkeeper, nobody has their spouse helping them, and 10% said their bank statement. So I'll hide those results and it's all yours again.
All right, well, thank you for that, Victoria. I'm going to assume that with the 0% having their spouse helping them, it's because so many of you already have an in-house accountant or outsourced it to a CPA. Hiring an accountant, it's important to evaluate your need. So is your need preparation of financial statements? Is your need taxes? Is your need around bookkeeping? Is your need around understanding what available accounting software or possibly even getting training on accounting software? And also, do you have a business need for the accountant, or does your need also include personal? Evaluating your need will ensure that you are quoted correctly. That's why I wanted to start with that. CPA firms work through engagement letters, and there is an additional service. If it needs to be added on, an additional service needs to be provided, a new engagement letter needs to be drawn up and signed. So it's always best to ensure that you understand and that the CPA understands what your actual needs are. This allows for the CPA to actually give you an engagement letter right from the beginning that encompasses the full level of services. Additionally, after you determine your need, you need to then determine whether you actually need to be talking to a CPA or if a bookkeeper will suffice. So when you look at bookkeeper or CPA, is your need around accounts payable or receivables work? Is your need simply payroll? Are you looking to hire someone to audit your financial statements or possibly do a review or a compilation of financial statements? Is it consulting work? Consulting work could be around assisting you to create a growth plan, assisting you to create projections, assisting you in creating a cost analysis for a project you may be going after. Or is your need around taxes, tax filings, or a response to an IRS audit? Obviously, if your need is around an audit or review of your financial statements, then you want to work with a certified public accountant. But if your need is around accounts payable, accounts receivable, payroll work, monthly bank reconciliations, then a bookkeeping firm would be enough. At times, you may find that you're working with both. And there may be times that the CPA firm offers both services. So I just wanted to make sure that when you're going through the process of hiring an accountant, you first and foremost start with understanding your need so you can evaluate the level of service that you need and whether a CPA or a bookkeeper would be enough. Continuing on with hiring an accountant. Things to review during the process. You want to review the CPA firm's website. You may go off of a referral, so their reputation and background is going to be important. I prefer referrals. I think it's better when you are being recommended by someone you're already working with. I think that holds a lot of weight when someone recommends your services. The size of the firm, their referrals, customer feedback credentials, it's all items that you should review prior to reaching out to the CPA firm and during the process of the initial engagement. When you understand your need, the size of the firm will definitely come into play. If your need is more around cash management and forecasting and creation of projections and budgets, you may have a stricter timeline on when you need these things completed. The capacity and size of the firm will help you determine whether this CPA firm is going to be able to provide that service to you in the time frame that you are requesting the work be done. So again, it goes back to understanding your need, because the better you understand your need, the more information you're going to be able to provide to the CPA, as well as the ability to express the urgency of your request. So again, going back, hiring an accountant to come in and get your books in order during this current climate, the size of the firm is definitely going to come into play, because smaller firms will be busy with their current clientele and may be too busy to take on the additional work, which means you may have to work with a bigger firm. And as you work with bigger firms, that also means that you're going to be paying bigger rates. So just keep that in mind, that it starts, again, knowing your need and then evaluating the reputation, size of the firm, and credentials. I wanted to include some additional resources that can help you with finding additional CPAs or evaluating the CPA firm. The resources are the State of Ohio Accountancy Board, associations like the Ohio Society of Certified Public Accountants or the American Institute of Certified Public Accountants. You could also refer to your local Chamber of Commerce. They may have accounting firms, bookkeeping, and CPA firms that are registered with their local chamber, and local small business resources like the Small Business Development Center, Hispanic Chambers, or Urban Leagues. These are good resources because it helps you find local firms, and we all try to support local, and that would be a great resource for you guys. As we move to conclude day 2, there is also a survey at the end of the webinar, which I appreciate if you guys take the time to fill out. Of course, I'm open to taking questions, but if there's additional questions that you didn't get to ask during the presentation, please feel free to email me at the info listed here on the slide. I'm more than happy to assist if you reach out. So I want to thank you all for participating, and I now turn it back over to Victoria for closing comments.
Thank you, Luis, and thank you everyone who's joined us today and for all of these webinars. We hope you find them to be an excellent source of information moving forward, and we will make certain to follow up and get you links to the recordings and that you have links to the handouts. Everyone stay safe and have a good day. Thank you.